Welcome back. Today we're diving deep into something huge, really a defining economic shift for this decade. It's the collision between artificial intelligence and, well, the aging U.S. power grid.
That's right. And our sources, they're all calling this a once-in-a-generation demand shock for electricity. It's not just a bit more
Right,
growth.
but a total reversal.
Yeah, exactly. I mean, think about it. For almost 20 years, the U.S. power industry saw basically zero demand growth, flatlined, less than 0.5% a year.
Stagnant.
Totally. And that era, it's definitively over.
Absolutely. And the engine driving this massive shift is AI. Specifically, it's the really hungry, relentless energy appetite of these data centers running the large language models.
So our mission today for you listening is to really get under the hood, understand the physics of this new demand and how it's kicking off, well, frankly, a multi-trillion-dollar investment supercycle in energy infrastructure.
Okay, let's start with the scale then, because I hear the numbers are pretty wild.
They really are. You have to start there. Consensus forecasts, the ones everyone's looking at, they suggest U.S. data center power use is set to double, maybe even triple by 2030.
Triple.
Yeah, adding over 100 gigawatts of new load. Just relentless demand.
100 GDWs.
Mm.
That's enormous. Is that forecast solid, though, or is just, the energy industry trying to drum up investment?
It's looking increasingly solid, mostly because the underlying tech, it just demands it. That flat demand we talked about, now projected to grow at 2.4% compound annual growth rate through 2030.
Wow. 2.4% CAGR. That's explosive compared to near zero.
It's a rate of expansion the sector hasn't seen in, well, a generation.
Okay, let's unpack the technical driver then. What makes this AI demand so inescapable?
It really comes down to the chips, the GPUs. So think about asking ChatGPT or another LLM a complex question. That query takes about 2.9 watt hours of electricity.
Okay.
Now compare that to a regular Google search, right? That's only 0.3 watt hour.
Wait. 10 times the electricity just for one complex AI query versus a standard search. No.
10 times, yeah. Driven by all that parallel processing GPUs have to do.
That fundamentally changes the game, doesn't it? It means it's not just about building more data centers. It's that every single AI task is just heavier, way heavier on the grid.
Exactly. And you see the big institutions rapidly trying to quantify this. Right now, data centers are maybe 3% of total U.S. electricity use.
Okay.
But connect that tech shift to the money side. Goldman Sachs, EPRI, DOE, they're all showing that share jumping aggressively, somewhere between 8%, maybe even 12% by 2030.
8 to 12% share. That's huge growth.
And globally, the International Energy Agency, the IEA, they project data center power consumption worldwide will more than double this decade. It's a global phenomenon.
What's also critical here, I think, is the type of power needed. This isn't like, demand that fluctuates with the weather.
No, not at all. These AI data centers, they run flat out, around the clock. We're talking utilization rates of 86% or higher.
Yeah.
They need power 24/7, 365.
Baseload power.
Pure baseload, which is frankly a brutal requirement for grids that are trying to integrate more intermittent renewables like wind and solar.
And there's the heat issue too, right?
Oh, absolutely. You pack all those processors together, they generate incredible heat. So you need massive cooling systems, HVAC, liquid cooling, you name it. And that cooling accounts for like 30% to 40% of the total energy the data center consumes.
Wow. So it's this inflexible, intense demand that needs power every single minute. No breaks.
Exactly. Non-negotiable.
Okay, so if demand is that relentless and concentrated, the cost to upgrade our system must be just staggering. You mentioned electricity becoming a strategic asset for big tech. What does the required spending actually look like? This must be where the trillions come in.
Yeah, this is the multi-trillion-dollar reality. The investment scale is just immense. McKinsey, for instance, they project global data center investment hitting $7 trillion by 2030.
Hold on. $7 trillion. Globally, it's like the entire GDP of, I don't know, Germany or the UK, just poured into this one sector.
It's almost hard to wrap your head around, isn't it? And that's just the data centers themselves.
What about the grid, the wires, the power plants?
Right. So Goldman Sachs estimates around $720 billion in grid spending is needed just in the U.S. through 2030. Separately, the Edison Electric Institute, they represent investor-owned utilities. They project over $1.1 trillion just between 2025 and 2029 for their members to upgrade and expand.
So staggering demand, staggering capital ready to flow. But here's where we hit the wall, right?
Mm-hmm.
The critical power bottleneck.
That's the crux of it. It's what people are calling the velocity mismatch. It's the core problem.
Velocity mismatch, explain that.
Okay, so data centers, they can be built relatively fast, 1 year, maybe 3 years max. These tech companies move at lightning speed.
Right, high velocity.
Exactly. But power plants, big transmission lines, those are low velocity projects. They take years, often a decade or more. Permitting, siting challenges, environmental reviews, construction. It's a marathon.
Ah, okay. So the demand is showing up way faster than the supply of power and transmission can possibly be built.
Precisely. Demand is immediate. Supply takes forever. That's the mismatch.
And the consequence of that bottleneck is what we're seeing now. Electricity shifting from just, an item on the expense sheet to a strategic asset.
Absolutely.
It's forcing big tech's hand. Look at their behavior.
Yeah.
They're scrambling to lock in 20-year power purchase agreements, PPAs, or even directly funding energy projects themselves. Why? Just to guarantee they can get the power they need when their multi-billion-dollar data center is ready.
Okay, now let's talk geography. Because this demand isn't spread out evenly across the country, is it?
Not at all. It's intensely concentrated,
Yeah.
which creates these acute, localized stress points on the grid,
Yeah.
specific geographic battlegrounds.
So we have to start with the absolute epicenter, right? PJM interconnection territory, specifically Northern Virginia, Data Center Alley.
Yeah, Dominion Energy's service territory there is ground zero. The load forecasts are just astonishing. PJM forecasts its total peak load growth through 2030.
A staggering 94% of that growth. Think about that. 30 out of 32 gigawatts is projected to come from data centers alone in that one region.
94%. So the grid there is just melting.
Pretty much. It's causing capacity auction prices. That's where generators promise to be available to spike to record highs. PJM is scrambling. They even proposed this really controversial new service called non-capacity backed load, NCBL.
Non-capacity backed load. What does that even mean?
It's revolutionary, maybe a bit desperate. It basically tries to prioritize connection speed over traditional grid reliability. It would let data centers connect faster.
Okay, sounds good for them.
But, and this is the huge catch, they'd have to accept the risk of being the first ones curtailed, basically shut off during a grid emergency to protect everyone else.
Wait a minute, you're saying PJM wants giants like Amazon or Microsoft to agree to have their power cut first just to get online faster? For businesses built on 99.999% uptime, that seems untenable.
Exactly. And the big operators are pushing back hard. It just highlights this direct conflict. The digital world needs perfect instant power, but the physical grid needs years, maybe decades, to adapt safely. Reliability is non-negotiable for these guys.
Okay, let's head south then, to ERCOT in Texas, the Wild West of power, as some call it. Growth there is also explosive.
Equally explosive, their 2030 data center demand forecast jumped by over 160% in just 1 year. It's now forecast up to nearly 78 gigawatts.
Wow.
But what's interesting in Texas is the mix. Data centers are booming, sure. But if you look at the queue for interconnections at American Electric Power, AEP, down there, committed load from cryptocurrency miners, about 5 JW, actually still surpasses data center requests, which are around 2 JW in their specific queue.
So Texas is juggling multiple huge power hogs simultaneously, crypto and AI.
Right. Multiple massive industrial appetites hitting the grid at the same time.
And the market response in ERCOT, since it's deregulated.
It's pretty clear. Independent power producers, the IPPs, they're jumping in. Building significant new natural gas peaker plants, upgrading existing gas plants. Why? To handle that inflexible 204/7 load and capitalize on the high prices and, well, the state's abundant gas supply.
Which brings us to the southeast, the next big frontier. Right. Georgia, the Carolinas.
Yeah, the surge there has been so sudden, so intense, that major utilities like Southern Company, Duke Energy, they've been forced to do something pretty drastic. Reverse course on planned coal plant retirements and propose massive build-outs of new natural gas generation just to keep the lights on and maintain grid reliability.
Hang on, that seems like the ultimate irony, doesn't it? AI, this symbol of the future, pushed by tech companies with huge climate goals and ESG commitments,
is actively forcing utilities to build more fossil fuel infrastructure that will likely run for decades.
Yeah. How do they even justify that? It seems like a direct clash with decarbonization goals.
Yeah. Well, from the utility perspective, they're arguing reliability and meeting immediate economic demand have to come first, at least in the near term. They say gas is the only dispatchable thing they can permit and build fast enough to meet this specific 247 load profile.
So reliability trumps speed of decarbonization for now.
In these specific regions, it seems so. And to try and manage the cost aspect, you see things like AEP Ohio creating special data center tariffs. The idea is to make sure these giant new users pay their fair share for the grid upgrades, so existing residential customers aren't footing the whole bill.
Trying to strike a balance.
Yeah.
Okay, so if the immediate solution is this gas bridge, but the long-term goal, especially for big tech, is carbon-free power, what does this imply for investment? We must be looking at a required generation mix that leans heavily on two main sources.
Exactly. It sets up this dynamic. A gas bridge for the near term and a nuclear long game for the future.
Okay, explain the gas bridge first.
Simple necessity. Natural gas is really the only dispatchable, meaning controllable, power source that can be permitted and built quickly enough to meet this demand surge over the next, say, 5 to 7 years. Goldman Sachs estimates something like 60% of the new capacity needed by 2030 will have to be gas-fired.
60% gas. Okay. And the long game.
That's nuclear. For the kind of 247 carbon-free power these huge tech companies ultimately want for their massive energy footprint, nuclear is increasingly seen as the ultimate strategic solution. This demand is actually driving a real acceleration in the talk around a nuclear renaissance.
Okay, so let's break down the investment opportunities then. You see it in tiers, starting with Tier 1, the regulated utilities, lower risk, focused on guaranteed growth.
Right. This is about guaranteed rate-based growth. They spend money on infrastructure capex, and regulators allow them to earn a return on that investment from customers. The evidence. Look at Dominion Energy, indispensable in Northern Virginia. They increased their 5-year capital expenditure plan by nearly $7 billion. It's over $50 billion now.
$7 billion increase. Okay.
And even more dramatic, American Electric Power, AEP. They operate in critical hubs like Ohio and Texas. They boosted their 5-year capex plan by a massive $16 billion, up to $70 billion total.
$16 billion in extra capex. That's a huge bet they're making on this digital load growth continuing, driving their rate-based expansion.
It's a direct reflection of the demand they see coming onto their systems. They build the backbone, they get regulated returns, safer bet.
Okay, moving to Tier 2. The independent power producers, the IPPs, more direct exposure to actual power prices.
Exactly. Growth potential. They benefit from rising wholesale power prices and can sign these lucrative long-term contracts directly with data centers or other big users. And here, Constellation Energy really stands out.
Why Constellation?
Simple. They own the largest nuclear fleet in the U.S. In a world suddenly desperate for clean, reliable 20-arc-47 power, their existing assets are like gold, and we're seeing landmark deals prove it. Well, Constellation is restarting 3 Mile Island Unit 1, the one that shut down years ago. They're rebranding it the Crane Clean Energy Center. And who's backing it? Microsoft, with a 20-year PPA.
20 years, wow.
And they also signed a deal with Meta, Facebook's parent, to provide the entire output of their Clinton nuclear plant in Illinois. These aren't small pilot programs. These are huge, long-term commitments locking in clean baseload power.
Okay, and Vistra Core, where do they fit in?
Vistra offers a different play, a strategic mix. They have significant gas and nuclear assets, primarily in ERCOT, Texas, and PJM. They're leaning into the gas bridge, too. They're actively planning to add up to 2,000 megawatts of new gas-fueled capacity in Texas, specifically targeting this data center and industrial load growth.
Capitalizing on that urgent need for near-term dispatchable power.
Yeah.
Makes sense.
Then we hit the final frontier, Tier 3, the disruptors. This is small modular reactors, SMRs, high risk, high reward.
Definitely higher risk, but potentially huge reward. And what's interesting is that big tech itself is actively helping to de-risk this technology by acting as potential anchor customers. They need the solution, so they're willing to support its development.
A key player here is NuScale Power. Huge first-mover advantage. They hold the first and, so far, only SMR design actually approved by the U.S. Nuclear Regulatory Commission, the NRC.
So their tech is certified, ready to go?
Certified for design, yeah. And they've already secured an agreement with a company called Standard Power to provide nearly 2 gigawatts of clean energy, specifically for data centers using their SMRs. It's moving from theory to actual commercial deals.
And Oklo Inc. They're another name you hear.
Right. Oklo has a different approach, developing even smaller microreactors. Their model is interesting. Power as a service. They recently signed a non-binding agreement, but still significant, with data center developer Switch, the potential, deploying up to 12 gigawatts of power using Oklo reactors by 2044.
12 gigawatts. That's massive scale long term. So big tech is essentially bankrolling the future of nuclear to secure their own power supply.
In a way, yeah, providing that crucial early demand signal and potential contracts.
So the core investment strategy here, especially if you believe in the nuclear long game, is what you call the nuclear barbell.
Precisely. It's a way to structure the investment. You pair a stable, established player like Constellation owning existing profitable nuclear assets with smaller, more speculative positions in the SMR developers like NuScale or Oklo, who represent the future potential.
Got it. Existing cash flow on one end, future growth potential on the other.
Exactly. And the data center demand is the engine fueling both ends of that barbell right now.
Okay, before we wrap up, we have to touch on the cost for everyone else. This unprecedented strain, this massive investment. It's not free, right?
No, absolutely not. The macroeconomic impact is significant. This huge grid investment, plus the tighter supply-demand balance, is expected to push electricity prices up for all consumers.
How much are we talking?
Well, projections suggest national average electricity prices could rise about 8% by 2030 purely due to this effect. And in some of those really high-growth areas, we talked about Northern Virginia, Texas, maybe parts of the Southeast, you could see local price jumps of 20%, maybe even 25%.
Wow, 25% higher bills in some places. That really puts the true cost of this AI revolution into perspective for everyone.
It does.
So securing reliable power, it's clearly shifted, hasn't it? From just like a basic utility concern to a top-tier C-suite priority for the biggest, most valuable companies in the world.
Absolutely. The foundational shift is complete. This is going to reshape the energy landscape for decades to come.
Okay, so let's leave our listeners with one final thought to chew on. A crucial uncertainty here is the risk of, well, demand speculation.
Right. This is the big what if. Data center developers, they often submit multiple, sometimes redundant requests to connect to the grid. It inflates the queue, inflates the forecasts, just to make sure they secure a spot.
So they're overbooking, essentially.
Potentially, yeah. So the question is, what if these current forecasts are a bit overinflated? What if AI computing gets dramatically more energy efficient, faster than we currently expect?
Then why?
Then there's a real non-trivial risk that utilities, and ultimately you, the ratepayers, could be stuck paying for billions of dollars in stranded assets. Massive power plants, new transmission lines, built for demand that never quite showed up at the scale predicted.
Billions in stranded assets. That's the high-stakes gamble at the heart of this whole energy supercycle, isn't it?
It really is. That uncertainty is what defines the next decade of energy investment.